For the next two lectures, we're going to bring monetary and fiscal policy together. And I hope that I can make it clear to you why it is that we almost always should be studying them simultaneously. The tradition is to separate monetary and fiscal policy, and that tradition is what we followed up until this point. Early in the semester, we looked at fiscal policy, changes in taxes, changes in government spending, with no reference at all to monetary policy. And then in the previous set of lectures, we looked at changes in the money supply and money demand without any reference to fiscal policy. So what we're going to do now is bring them together. Although I didn't emphasize this semester, the set of notes called Money and Prices 2 talks about hyperinflations, and that's one example where monetary and fiscal policy are brought together. But what I want to emphasize is a broader view of monetary and fiscal policy. And the theme is going to be that the effects of monetary policy always depend on fiscal behavior, and it's symmetric. The effects of fiscal policy always depend on monetary behavior. So we've studied models that have two real assets. We had capital and bonds. We just got done looking at a model with one nominal asset, money. And now what we're going to do is add some realism. We're going to acknowledge that the vast majority of government debt that advanced economies issue is nominal. They do index some debt, or they issue some index debt, which is like real debt. But that in most countries is a fairly small fraction of the total debt that the government issues. So we're going to look at an economy. We're going to kind of go back to the endowment economy that we looked at before, where there were two periods. But we're now going to have these two nominal assets. There's going to be M, which is high-powered money. That will consist of bank reserves plus currency. And then there's going to be B, which will be government debt. But now this is nominal government debt. So it is in dollars. And that debt will pay a gross nominal interest rate, 1 plus capital R. Money and bonds are going to have a common price in terms of goods, which is 1 over P, the price level. 1 over P is the goods price of $1. In other words, to acquire $1, how many goods do you have to give up? Well, 1 over P. And as I said, we're returning to that simple model, two periods where output is exogenous. So now, what does the Fed do, the Federal Reserve? Well, there are four main duties. One is it conducts monetary policy. So it changes interest rates, short-term interest rates, in order to influence monetary and credit conditions. And the objective, ultimately, is to try to maintain maximum employment, stable prices, and moderate long-term interest rates. These three objectives are specifically mentioned in the Federal Reserve Act that Congress passed that controls what the Fed does. A second duty is to supervise and regulate banks, to ensure the safety and soundness of the banking and financial system, and to protect the credit rights of consumers. Third is to maintain the stability of the financial system and contain systemic risk that could arise from financial markets. Systemic risk means risk that affects the entire financial system. And fourth, to provide financial services to depository institutions, the U.S. government, and foreign official institutions. We're going to focus on the conduct of monetary policy, but during this financial crisis, 3 and 4 became really major things that the Fed did in order to try to stabilize not just the U.S. economy, but the whole world economy. So how does the Fed conduct monetary policy? Well, it sets a target for the federal funds rate. in order to try to achieve those three goals that we talked about. That is the maximum employment, stable prices, and moderate long-term interest rates. The federal funds rate is a very special interest rate. It is the interest rate that is charged on overnight loans of reserves between banks. Reserves are basically a kind of liquidity that banks have. They can take the form of actual cash that they have in their vaults, or deposits that these banks have with the Federal Reserve. Banks are required to maintain a minimum level of reserves, and well, reserves don't literally earn zero interest. Nowadays they earn some positive but very small interest. And so banks basically try to minimize the reserves that they hold. Although, as we will see, that hasn't been happening in the last 5 years. So what the Fed does is it targets the price of reserves, which is the federal funds rate, by varying the supply of reserves. And it can alter the supply of reserves by conducting open market operations. Those are swaps of Treasury securities for reserves. So the Federal Reserve can go out into the open market, buy Treasury bonds, and pay for those bonds by creating new reserves. Okay, so open market operations. An open market sale means that the Fed is selling these Treasury securities in exchange for reserves. So this reduces the supply of reserves, and therefore that causes the supply to shift to the left. This contracts high-powered money, and it raises the federal funds rate. So if the Fed wants to raise the federal funds rate, it'll conduct an open market sale. If it wants to reduce the federal funds rate, it'll conduct an open market purchase. That's when the Fed buys securities, it pays for them by creating new reserves. That shifts the supply of reserves out to the right, and that expands high-powered money. Now, generally, other interest rates, the interest rates on bonds, loans, etc., tend to move in the same direction as the federal funds rate. So when the Fed raises the federal funds rate by doing an open market an open market sale, that tends to shift up all interest rates in the economy. But open market operations also change the balance sheets at the Fed and in the banking system. High-powered money is defined as the sum of reserves, those are bank reserves, and currency. So this is a highly stylized balance sheet for the Federal Reserve. The Fed has assets that consist of Treasury securities. Those are the things that they're buying and selling when they do open market operations. And then there's some other assets. And the Fed's liabilities are these bank reserves. So those are deposits that banks have with the Fed. And currency. Those are really the two key liabilities. And then they have other liabilities and some capital. Now, at the end of 2006, so remember this is before this financial crisis, what we saw was that Treasury securities were about $779 billion, other assets about $95. Bank reserves were quite small, $13 billion, and currency was $783 billion. So most of the Fed's liabilities were in the form of currency. That's literally green pieces of paper. Then came the financial crisis. What did the Fed do? It massively bought securities, Treasury securities, and it also took on a bunch of other assets. And how did it pay for these things? It paid for them by printing up some more currency, but that's not the most of what they did. Mostly what they did was they just created these bank reserves. So you can see that bank reserves are now on the order of, 100 times what they were at the end of 2006. And the Fed's balance sheet is roughly 3 times the size that it was at the end of 2006. And this was all as a consequence of the financial crisis.